In this video, we're going to talk about the investment rules. So we're going to review net present value from a previous video. We're also going to discuss the relationships between the different techniques. There are 6 or 7 capital budgeting analysis techniques that we can use. And in this case, we're going to try to understand the pros and cons of each one of those techniques, why they work, why they're important, when they don't work. So let's work our way through that this particular chapter video. So here we have an investment, and essentially it's a $2,000 project. It's going to give us $500 per year for the foreseeable future. And in this case, really all we want to get from this particular slide is the importance of the variables, right? So we need to know what a project costs. That's obvious. We should know what that is, right? It shouldn't be something that is forecasted. You know what things cost. The next thing we have to look at then is the cash flows. Now, these are obviously forecasted. We think they're going to happen in the future. It's what we have predicted through looking at other projects, looking at our history, etc. The thing that this particular slide is really trying to talk about, though, is this variable R. And R is the discount rate. Sometimes it's going to be referred to as the required return. And in the capital budgeting context, it's also referred to as the cost of capital. So the cost of financing, right? What does it cost to borrow? What does it cost to issue common stock? How does the company utilize this combination of stocks and bonds, of issuing them to finance operations? So the required return is very important. And we'll discuss that as we go along. So this comes from a worksheet that's called the net present value profile. And if you look at the actual data, if you will, of this project, you can see here in this first column, we have listed the potential discount rates, the R's, if you will. And in this column, we actually have the net present values based on that discount rate. So all we've done is solve this formula using a variety of discount rates. And what you see here is we get a graph. This is called the net present value profile. And what you see is that it has a negative slope to it, and there's a point where it crosses the axis for 0 net present value. This will all become a little bit more important, a little clearer as we go along. But the idea here is you can say, well, what is the net present value at different discount rates? If the cost of capital is 17%, you can see that the net present value is $941. Remember, net present value talks about the increase in value or wealth to the company should they do this particular project. What if it's 25%? 25%, the net present value is 0. And of course, anything more, any higher discount rates will have lower and lower net present values, and now they are negative, which obviously implies reducing the wealth of shareholders and owners. Excuse me. So again, the idea here, what do we get from this picture? Number one, as discount rates increase, as the cost of capital increases, as the riskiness of the company or the project increases, the value of the project to the company also, as it increases, it decreases. So as these numbers go up, the value of the project goes down. So if you want to have many projects that are going to help your company, you need to find a way to keep the cost of financing as low as you possibly can. So there are alternative rules, of course, to net present value, right? Sometimes they're going to agree with net present value, sometimes they won't. When the rules conflict, the general rule to follow then is net present value should be followed. So in other words, net present value always gives you the right answer. The issue is it's not the most user-friendly kind of an answer. Not everybody really understands it. Net present value measures the change in wealth of the firm that's expected if you implement this project and the cash flows occur. So it's a very important concept when you think about investment and overall what the goal of the company is, right? The goal of the company is to grow and to increase its value for its owners. So the first technique to talk about is something called the internal rate of return. So if the internal rate of return is greater than the cost of capital, then that means that the cost of financing is less than the return that you get from the investment. So the internal rate of return, in other words, to give it a definition, the internal rate of return is the rate of return earned on the investment if you pay the cost, the price to purchase the investment, and the cash flows actually occur the way you predicted them. It's the rate of return you earn. So if the cost of financing that rate of return is less than that, then that's a good project. Obviously, if it's more than that, then it's not. Most of the time, the internal rate of return rule will give the same exact answer as net present value, but not all the time. In general, this internal rate of return rule works for any standalone projects of the company. If all of the project's negative cash flows precede its positive cash flows. So what that means is, and we'll have an example of this here in a couple of minutes, we have to have a series of cash flows where you spend money, negative cash outflow, followed by a series of positive cash flows. Again, whenever the cost of capital is below the internal rate of return, this then implies that the project is going to have a positive net present value. So the rule, internal rate of return and net present value agree with each other in all instances except for a couple. So when we see projects that are these others, right, then you need to understand that the cost of the internal rate of return is not going to give us an answer that reflects increased value. So what are these rules? Well, the three basic ways or times that net present value will not agree is with delayed investments, if there's a non-existent internal rate of return, and if there are multiple internal rates of returns. So we're going to work our way through some examples so we can understand and see how this conflict happens and why it creates problems for us. So let's talk about a delayed investment. You've just retired. A publisher offers you a book deal. They're going to give you $1 million today. if you agree to write the book about the experiences. And of course, it's going to take you around 3 years to write the book. Now, while you're writing this book, you're not going to be able to do anything else. You're going to have to give up any speaking engagements that you might have. That is about $500,000 a year. So you get $1 million up front, but you have to spend or lose $500,000 a year for the next 3 years. And your opportunity cost is 10%. Now we're going to use a worksheet for this. It's called the Capital Budgeting Techniques Worksheet. And obviously you can download that from the workbook. So here's how we do this. The delayed investments. Should you accept this deal, we need to calculate the internal rate of return. So in this case, for this capital budgeting technique worksheet, you have to input the data. Well, if you'll notice, this data is different, right? How I mentioned a little bit earlier, if you have negative cash flows followed by a bunch of positive, then internal rate of return, net present value will agree with each other. In this case, it's backwards. We have positive followed by a bunch of negative. So in this case, if you look at, here are the 3 years of negative outflows, right? These are opportunity costs, of course. If you look down here, the internal rate of return is 23%. That's a very high rate of return. If you have an opportunity of 10%, this is definitely a better project, or a decent project, it seems. But let's look at net present value. In this case, net present value is actually negative. So what's going on? These things are disagreeing with each other. And in fact, it says this is not a really good project at all. This is actually a bad project. In fact, if this person did this project, essentially, they would be reducing their wealth over the next 3 years. They would be reducing their wealth by almost $250,000. So if we look at a picture in this capital budgeting techniques worksheet, there is a net present value profile that's created. And what you can see here is that in this case, it has a positive slope to it. Well, that just doesn't make sense, right? As the cost of financing goes up, as costs go up, values go down. This is going in the opposite direction. So again, in this case, we can see that the internal rate of return is not the correct technique to use because it gives us an incorrect relationship between risk and value. The next one is something called multiple internal rates of returns. In this case, we have what? The publisher is going to give you $550,000 in advance. You lose $500,000 a year, obviously. And then in year 4, when the project is done, you'll get another $1 million. So here it goes positive, 3 years of negative, 1 year of positive. So we have a switching of the signs now. So it's not negative followed by a bunch of positives. It's positive, bunch of negatives, positive. How does that look with this particular worksheet? Well, as you can see in the worksheet, and again, you have to kind of understand, there's a video that talks about this worksheet. It's called Capital Budgeting Techniques. And it talks about how you set up this profile so that you get the correct graph. But if you look at this picture, you can see what? For anything less than 11%, net present value is positive. For anything more than 31%, it's also positive. But in between, it's negative. So what this has created is this, I think this is called a parabola, but I'm not very good on my geometric shapes anymore. But you can see that it crosses the 0 axis in 2 places. So the importance of the 0 axis in this net present value is that it identifies the internal rate of return. And that happens, again, the internal rate of return happens when the net present value is 0, and it identifies the cost of capital at which that will occur. So we have two answers. And of course, having two answers is no good to us, right? You know, which answer is better? Is it the, again, it's somewhere between 6 and 11, right? So we'll just pick a number. Let's say it's 8%. And down here, let's say it's 34%. Well, which answer is correct, 8 or 34? And mathematically, both answers are correct. So again, the idea here is that internal rate of return in this instance doesn't work very well. In fact, doesn't work at all because it gives us too many answers. The third, they refer to these as pitfalls, but the third category is what we refer to as a non-existent internal rate of return. You get 600,000 in advance and $1 million at the end, right? And again, with those cash flows, and what you can see here is, if you look at the data, there is no negative net present values. So there is no point at which this curvilinear function crosses the 0 axis. So what that means is there is no internal rate of return answer. So while the internal rate of return rule does have shortcomings, if we remember these three instances and we look for them, then the internal rate of return is still going to be useful. It measures the average return on the investment and the sensitivity of the net present value to any kinds of errors that we may have in cost of capital. So that's the end of this video. I look forward to seeing you in the next video.